Welcome to the Send More Offers Real Estate Show with Brandon Barnes, showing you how to do wholesaling deals consistently without having to go on seller appointments. Learn the key tips and strategies that Brandon's students use to find deeply discounted properties that are pennies on the dollar, all while avoiding wear and tear on their vehicle, body, and freedom. Whether you're looking for your first deal or your next deal, it's time to send more offers with your host, Brandon Barnes.
Hey, Jim, welcome to the show. Super excited to have you here.
Thanks for having me, Brandon. Good to be here.
Yeah, look, I know we got a lot to talk about. You guys are doing an amazing thing with build-to-rent. I know you have your own finance company, you're a published author, and then also the bulk foreclosure acquisitions process. I'm super excited to hear about that. But let's just start kind of with, how you transitioned from your business prior to the build-to-rent into the build-to-rent space and what that looks like now.
Yeah, this is my 25th year, Brandon. I'm an old timer, I guess now, which is crazy to think. And I started in the foreclosure game. First, it was HUD foreclosures in California. And then years ago, moving to Florida, the bank foreclosures. And me and my now building partner, we built up a network of acquisition people through REO brokers and directly to banks. And we were buying these foreclosures in bulk. And it was a great business model. We were getting hired by big investor groups or individual investors to get them properties, build our own portfolios. But I started to learn some very big lessons in the bulk foreclosures. And I think it can all be summed up into one word: unknowns. When you're working with older properties in questionable areas, it just ups the unknowns. How much are the repairs going to be? What repairs don't you see right now, but you're going to find out in a bad way 12 to 18 months from now? How much turnovers are actually going to be? This was a big learning process. And it took me from, those old bulk foreclosures into what we do now, which is building better properties in better areas with better results.
Yeah. And what you just mentioned, what do you mean? What do you think is coming in the next 12 to 18 months?
The next 12 to 18 months is going to be interesting by area. I've always looked at real estate, being in California years ago and leaving in 2005, which was a very good time to get out of there. I'm always looking at individual areas, Brandon. The weather's different everywhere. And so, for example, we have a lot of investors coming to us from Salt Lake City, Utah right now. They've have experience out there. They have properties. The numbers just don't work, and their average median price for a home is almost $300,000 more than here in Jacksonville, Florida, which is not far from where you are. And so I'm always looking for, where is the intrinsic value still? Where is growth occurring still? Where is the median value still low compared to a higher family income? So these are the things I look for. And I believe the next 12 to 18 months, as we go through an election cycle, and it seems every election, they always want to get reelected, no matter who it is. So they lower rates and make things more favorable. So that's going to be good for guys like you and I. And I believe the Southeast, especially Florida, and then also in the Midland of Texas, is going to have the most growth. In fact, I just got a stat last week in an event: 60% of all growth in the United States, population growth, is going to Texas and Florida right now.
That's interesting, because I know Southeast has generally been where I think a lot of investors, especially buy and hold investors and rehabbers, I guess new construction as well, have been looking at going into the Southeast because there's just overwhelming growth. But I hadn't heard specifically Texas and Florida. Do you know what may be driving those two states' growth?
I think they have a business-friendly atmosphere. I think they have a landlord-friendly atmosphere. And I think that there was some favoritism to ways that they handled the last few years compared to other states. Especially, landlords, we all got to look out. It's different out there now. I had friends in New York State, and this isn't political. This is pure landlord. And they had a great portfolio, bringing them in $15,000 to $20,000 a month. And they went from that to losing $10,000 to $12,000 a month because they couldn't collect rents. You got to go where you can collect rents. And I think that's a changing dynamic in the United States. So I don't care where you sit on the political aisle. That's not my concern. My concern is, as a landlord, will you be able to collect rents?
Yeah. And then I know the foreclosure and then the eviction process has been a hold up, specifically in Georgia. It's been backed up and slowed up since COVID. To your point, folks aren't able to, turn those properties over and collect new rent. So, that makes a lot of sense. And I've learned from, past, build to rent specialists, right? New construction, like you have to be very dialed in to the market conditions. What do you think is going to transpire just generally in the real estate investing space with interest rates and et cetera over the next few years? Do you think prices will stay stagnant, grow? What do you think?
We always have to look at inventory, Brandon. Inventory is the old supply and demand, and inventory oversupply, like we saw like never before in '07, caused the greatest real estate meltdown we've seen in 100 years.
Right.
Right now, we still have an inventory shortage, especially on smaller units, 1,400 square feet or less in the residential space. So I believe areas that are experiencing growth and are more of these workforce housing, this affordability level, but in solid areas, they're going to still experience appreciation. There's no way they can't, especially if the price points are still fair right now and rates drop. So I think that's something that we have to look for. I think the commercial space, and I have a lot of friends in the commercial space, this is coming directly from them. The banks are asking for more equity for these guys to build large multi-units or even finance it. So there's this little under the radar niche that we're in, that a lot of the big guys used to laugh at. But now that we're doing bulk of single family duplexes and quads and getting that residential financing. I mean, my commercial buddies, it's a dream of dreams for them to lock in at 4.75 now, with a 30-year
Right.
They can't do that. So I think that's going to open up a very big market for these smaller multis. Not to mention, as end of November, Fannie and Freddie changed the rules. Fannie Mae went from a new homeowner can walk in to a duplex or a quad for 5% down, where it used to be 25% down. Talk about the house hackers coming out. Like one of our new developments here in Jacksonville. It's a very nice area, Mandarin, Jacksonville. And these quads are almost $1 million, $989. And the first 3 that we sold were to house hackers who just want to live for free. And we're able to qualify with the FHA loan. And they said, well, I only have to put 5% down. I'm going to live here for the next year and then probably move out. And so that's opening up a whole new realm in our niche. So I think you really have to be aware of where you are. Is there growth occurring? Is there financing available? And is there an undersupply of housing or is there an oversupply?
Love it. And I think you just answered my next question. It was going to be, is it better to be in single family or multifamily? But I think, and when I meant multifamily, I meant large multifamily. And I think the answer is single family and small multifamily all day. So really, really good stuff. Let's dial it back to the bulk foreclosure model. I want to hear and learn about what that process is. If you wanted to go out and do bulk foreclosures right now, what that looks like. And then we'll pivot to the build to rent business model and break that down. So, bulk foreclosures, how does it work? Could somebody still do that today? What would they do?
It's everything has a season, and I'm not saying it's not going to be a season of bulk foreclosures again. I don't think it's now. I still have guys. There's a couple of different ways that you can buy foreclosures in bulks. You can create relationships directly with the REO brokers who get all the bank listings when they come back. That was one of the ways that me and my now building partner bought a lot of properties. Then, you could possibly go to some asset managers directly at the bank. You usually have to have a track record to start doing that. And they could start to make deals of selling, more small groups of properties to you. You can also go right to the courthouse steps. I had a number of friends, including my now building partner. I always went more to the REO brokers and dealt with the asset managers, but you can buy them right at the courthouse steps. And there's properties coming out all the time. What we've seen in recent years, the spreads just aren't there. It's a lot tighter than it used to be. It was a playground. You got to go through a lot of pain to get through, to the best times. 07, 08 was very painful for me. But 2009, 2010, 2011, the deals, we were buying properties what they were built for in like 1982. It was insane of what it was available for. So to do the bulk foreclosure model, first and foremost, if you're holding the properties, look, if you're just buying them and trying to flip them real quick, that's its own model. We were always a hands-on group where we would buy them and renovate them, keep them for ourselves, or work with an investor or an investor group. You got to have people that are going to fix them. And this is one of the things that I even saw the larger hedge funds that we dealt some with. They didn't realize all the work that went into buying a foreclosure and then getting it fixed. It was kind of, you buy the property and get it fixed. Well, finding the right people to do that, to show up, to make sure they're there, that is its own orchestra. And you got to be able to conduct that really well. You also have to build relationships. So for me, I had relationships with the top REO brokers in Northeast Florida. And I just made sure that I was their client, and I always let them represent both sides. They represented the bank, they represented me, and I just put in a lot of offers every week, cash close 5 to 7 days, and that kind of put us ahead. So I do think there could be a season for that coming again, Brandon. I don't think it's now, but a lot can happen in the next few years. But with bulk foreclosures, you got to have those relationships. You got to be, if you're doing the fix up, better have your guys ready and lined up to do that, especially if you're doing bulk. Because if you buy 20 this month and you buy 20 next month and 20 the next month after that and 20 again, that's a lot of houses to keep up on your hand. Yeah, and sure. You can start to get a little stifled. So that's my best advice on that.
Yeah, no, a few good things there. Sending more offers, right? Super important. And, that's something that I always beat the drum on. I'd been hearing that foreclosures were starting to uptick post COVID, protections. But I think it makes sense what you're saying because interest rates are higher, so harder to, get financing. And so I could see that market may not be what it was in the past. To your point of building relationships with some of the top REO, and this is my last question on this, the top REO agents, did you have a track record when you first started? What types of deals were you doing to show them to build the relationship, or did you have the funding behind you and that allowed you to get these opportunities early on?
Yeah, well, I had developed a reputation for buying a good amount of properties, so they knew I was serious. And I also lined up money where I could close very fast.
Got it.
If you're going to an REO broker and you're like, well, yeah, I'm financing it through this group and I need inspection periods and this and that, depending on the finance, they're going to throw it out. I always made it dead simple, Brandon. I was like, I'm an agent, but I want you to represent me. So you represent, keep both sides of the commission. And I would like to put in offers in these areas, this and that, and I will perform. And sure enough, if you're a REO broker and they get you into the rotation, you got to earn your way in because there's so much busyness, then you better be able to perform because their job is to bring it to the bank. And the bank wants it. So which one is most likely to go through without headaches, even if it's not the highest offer? Because the asset managers, they want this off their plate. So that's what I did. And when a deal came in, Brandon, I performed. I could close in 7 days without issue. No problem, no repair contingencies because I had already gone out and looked at the property and assessed my risk. So that was absolutely key. Nice. So to build those relationships, you need a reputation, but it starts with that first one.
Got it.
If you with one of these, and also there's some really good wholesalers that I worked with out there who had their own relationships, found their own things. And, they were leaving a lot of meat on the bone for me. So I'd work with them and they knew I was easy to work with. He will perform and he will do volume. So when you start to develop that reputation, it's easier to get into a flow of deals.
Love it. Love it. Just a quick question as a follow-up. Did you ever work directly with homeowners that were going through foreclosure, or did you skip over that and go straight to the brokers?
Years ago, I worked some short sales. It wasn't my favorite thing to do. They're very tedious. They can be very long-winded. They can be great if they work out, but they can also go nowhere. So I did do some of that when they were behind. And way back in the day, I used to take over some properties subject to. Again, not something I've done in 20 years now, but it used to be something helping people out of foreclosures. And that was a decent way to grow it as well. But short sales, I think, will come back. just be ready if you're in short sales. They are a tedious process, and you really need to have someone who knows how to work a short sale file in order to get it through.
For sure. Yeah. And I was thinking more in the subject to realm, but it's interesting because that's such a hot topic. Everybody's saying, oh, that's the only way you can get good deals now is subject to. And you're like, no, I did that 20 years ago. I'm doing this build to rent thing and I love it. So let's pivot to the build to rent model. When did you have that aha moment? How did it look? And what was the first things that you do to set up this build to rent process that you do now?
Yeah, it started about 10 years ago because the deals that I told you were so incredible in 2009, 10, 11, 12, they were starting to dry up. You know, all the bank inventory that occurred the '08 meltdown was drying up. There were more people jumping. All the TV shows are coming on and how fun it is to rehab a house, which is not true for any of us rehabbers out there laughing. It's not quite as fun as the TV shows make it. And we just had to, it was like a necessity. If we wanted kills, we had to find something else because the fixer-uppers that were available, the prices were too high. The numbers weren't lining up. The only way to make the numbers work was to cut corners on the rehab, which is a recipe for disaster in the short term. And I owned a lot of these, Brandon, and I just didn't like the 3-year curse. Didn't like it. And all that means is, I could do new heating and cooling, new roof, new plumbing, updated electric, ace bats, everything. And by year 3, I just knew with these older homes, I was going to have more turnover and more repairs. They started to go up and up by year 3. And that's
got it. Because you were fixing them up and holding.
Yeah. Or even my investors. And I worked with a large investor base. And yeah, they did good on rental growth and equity. But one thing you got to look at, especially if you're building a portfolio, is that downside risk of extra turnover, extra maintenance and repairs. And the older homes just had more of that. You know, and so going into the new construction model, you know, we've been doing this almost a decade now. We haven't seen the 3-year curse that long. You know, our tenancy went from just over a year to just over 3 years. So our average tenant right now is staying just over 3 years. Our maintenance and repair, like on that first turn, first of all, your first turn on a property being a year later, you're talking 3 years later, which is a great momentum. And that average turn is about 70% less than what we had to do on the homes. Huge. There's less headache, better growth to rents and values, because I've done a few thousand of the old ones and a few thousand of the new ones now. And there was no comparison. So for ourselves, for our investor base, because most of our investor base are successful professionals, business owners, they want to be in the real estate game, the residential real estate game, and build to rent without getting their hands dirty, without creating the second job. And we saw the amount of time and involvement they had to have with building a portfolio of old houses compared to, there was no comparison. So we got into it really by mistake and necessity. We started with putting in some development fees together, me and my building partner, and we built about $3 million worth of single family homes in a nice area of Northwest Jacksonville. And it went okay at best. But
did you have somebody holding your hand or did you partner with the builder and say, hey, I'm going to try this out?
We partnered with a builder on the first ones. And then about 2 years later, we decided to become a self-build. So we are the builder on all of our own projects all over Florida now, which was a really pivotal move that we had to do. And we didn't realize because when the the pandemic happened, if we had not done that, we wouldn't have had anyone to get our work done. So it was really important. But that first one, we had hands holding. We learned some lessons about screening the right tenants, the important, group of houses off on the right foot without any questionable tenants in there, doing really good screening. Because if it gets off on the right foot, it takes off, especially if you're in an area with a lot of home ownership and you've placed the house as well within that. But if it can go the opposite. So that was a big lesson that we had. But again, that aha'd us, so that first year last year we did about 185 million. So you can see the growth pattern. I could have never done that, Brandon, with the old model of finding old houses and fixing them up. There's just no way to scale it the way we were able to do with new construction because you start from scratch without surprises, better areas, less turnover, strong numbers. Yeah, you're going to sacrifice a little bit of cash flow up front. But when you look at all the other fundamentals, the overall, especially when you look 5 years on a buy and hold, has way outperformed the old.
Love it. Yeah. And I love the model because, if you're building new construction to put on the market, right, you're always beholden to what's going on in the market. But if you're building to rent, you typically have immediate, payback or pay down on some of the financing it took to build and do the project. You're getting somebody in there. I'm sure you guys have built up a good base of either tenant buyers or folks that are already, chomping at the bit to rent your properties. But let's talk about the managing the fund and the investors piece. Going into this, you're now working with a network of professionals that don't want to get their hands dirty. How's that management? Did you go and create an SEC regulated fund, or is this just a syndication? What did that look like? How do you manage it? How do you keep them happy?
Now we used to have land funds where people would come in with us and help us buy, because we own 5,000 lots in Florida right now, a little over 5,000 lots.
Empty lots
that we're going to build out.
Wow.
So we really went heavily in 2019, 2020 into owning lands. We took a risk and we said, this COVID thing's either going to be good for real estate or it's going to be bad. So we're going to be either right or dead wrong. So we went all in, and we had some land funds. We've since paid back all that, and we don't have any debt on the land. And we don't do funds. We actually only do individual ownership. So nice. These people, we're not combining funds. Let's say on average, doctor out of Northern California comes to us and he's like, I'm doing great income. I want to have something to fall back on in a few years. And he'll buy 5 to 7 properties. We get him the individual financing on each one. He owns the property. He doesn't need a construction loan. He just steps in at the end. And since we're on a continual build cycle, you can close on one of our new constructions in 60 days. You're not waiting a year or anything like our construction groups. We get him the thing, and then he owns the property, and 99% of people use us for further management because we have a management company. And so it's very clean what we do. Even some of the larger institutions or family offices, we're not, again, syndication money to buy and keep these. I mean, we keep our own in the company that, where we build, but every person is just their own entity, whether they're an individual or maybe a family office. And we just step in and we deliver the great properties and the management, and a lot of the times the financing.
Love it. Love it. And so at this point, I know folks probably are reaching out to you. They're seeing what you're doing, seeing your track record. They're wanting to be a part of this. Was there a point where you had to go out and reach out to some of these professionals and raise capital? Did you rely on your network? How did you build this base?
We're always, I am for our business, again, I couldn't do what I do on our own. We have 140 people on our team. But for me, as a partner in the business, my business partner handles all the operations and management, and I get to have the fun conversations. So I am always on stage somewhere talking. I'm always on a podcast. We're hosting an event. I'm hosting webinars. So I'm always bringing in clients and working with them and working with our property counselor team to help do that, because I've been able to, over the last, 20 plus years, build some really successful portfolios for a lot of investors out. We have a great track record with, we have a lot of great case studies with. And so I'm just always getting the word out. The last thing I did was we just released this book. My wife called The Passive Income Playbook, How to Leverage Build to Buy Back Your Time and Have a Legendary Family Life. Because I have 5 kids, Brandon. So I want to enjoy my time with them. Real estate's supposed to provide time, not take away. And there were years for me, I was making money, but I had no time. And that was the old fixer-upper days. So I'm always trying to figure out that same model I've done for myself for our investors. And that's what I focus on. But it's a continual invitation and conversation with new people. Again, we have about 935 investors that grows weekly. And we want to get that to about 5,000 investors with our expansion. But so that's a continual conversation to be had.
Very cool. What type of returns can investors expect from these projects?
Our properties right now are at about a 5 to 7 cap, sometimes an 8 cap on the duplex and quads. So that's that. And that's for the new construction model.
Love it. Love it. Awesome, man. Well, this is very interesting. And I love, kind of walking me through the process. And I know you guys are continuing to grow. But if you think back to maybe some of the earlier days or some of the interesting projects that you've been a part of, can you think of a deal for our Deal Diary segment that maybe had some hair on it or a funny story, interesting deal at all?
I'd probably go to that first deal, Brandon, where we built that small, it was about 27 houses. Really good area in Northwest Jacksonville for a scattered group of lots in a very nice development that the national home builders had done. They were moving to the next project. They sold it to us. And so there were a lot of homeowners there, which I like to have homeowners around my rentals. I think it's better for keeping the area up in value and safety and desirability. So we thought it was a slam dunk. Here's what happened. We were so excited to just try to build these and sell them. We didn't screen our buyers. And let me tell you what that means. We had about 5 buyers out of the 20 that came out of California, and they were super busy to get into real estate. And they said, well, without full knowledge, I can manage the property myself. And we're like, sure. We offer management. Brandon, like I said, if you screen properly a tenant, you put yourself in a very dangerous situation. And these 5 buyers didn't screen, didn't look into it, the credit history, the criminal history, and they moved in some pretty tough tenants to this small little area.
Oh my goodness.
And man, it's not a good way to start off a new neighborhood. And it took us a year and a half to really lick the wounds and help the rest. And it pisses off the other investors in there who had used our management or screen. So we've really become very cautious and screening our buyers to make sure, can they handle it? And also telling this story so they can avoid it. Because, man, a new construction area, if you do it right, it can take off in such a good way. But we saw that first one, Brandon, 20-something houses with 4 or 5 bad tenants. It ain't in your favor.
Yeah.
And so that is a painful reminder. It kind of makes me surprised that we kept going, to be honest with you.
What type of situations did those tenants bring with them?
Oh, there were some very, very, very large neighborhood parties that scared the shit out of some of the other tenants. So there were some definite crazy activities happening, and it could have been avoided. It could have definitely been avoided. And so, that was interesting. Yeah. I don't like to think about it too much. Being almost a decade away, I can sit there and laugh. I wasn't laughing 9 years ago.
I bet. Great lesson learned. Awesome, man. Well, look, I can't let you go without putting you through the lightning round. Are you ready for that?
Yeah, let's lightning round.
All right, let's do it. Cool. So look, I have a series of rapid fire questions for you. You don't know the question. I don't know your answer. So just say the very first thing that comes to your mind. What's one book that's been instrumental to your growth as a real estate investor?
First one I ever read was Real Estate Riches by Dolf to Roos. Great book. I had my sons read it as their first book.
Awesome. Is that the one that got you? It was
part of the Rich Dad Poor Dad series for a while, and then I don't know what happened. It's no longer, but you can still find it out there. It was just a real sound, fundamental book.
Okay. Awesome. Love it. I'll check that out. What is your best advice for someone looking to do their very first, maybe build to rent deal?
Know that you're probably not going to retire in the next 6 months.
Okay. Good stuff. Yeah. So if you could have drinks or coffee with any one person, dead or alive, who would it be and why?
My 2 grandfathers, because one I got to know very well and I love him and I miss him. The other one died when my father was 6 years old, but was an incredible man, entrepreneur, soldier, and I'd like to meet and have conversations with both of them.
Yeah, that's awesome. Good stuff. What's one mistake on a deal or business in general that if you could do it over, you would take that do-over?
It'd be a general, like how we were talking about the overall journey that I've had. I got wrapped up in, Brandon, of owning more and more properties, but I was not looking at quality or results. So my big advice for myself, my younger self, or even close family and friends is own less of better quality with less leverage. And then you can grow better, you can enjoy more and have less headaches.
Awesome. Love it. Love it. What is the financial goal for your team for this calendar year? What are you guys shooting towards doing this year?
We're looking to do about 200 million in sales. That's our goal this year.
Awesome. Good stuff. If you woke up tomorrow with $500 million deposited into your account overnight, what's the first thing you would go out and purchase with that newfound money?
Coffee.
Wait, what?
I'd want to go for coffee with my wife and say, what are we going to do for this?
That's a good point. I like it. What would you tell the person that's looking to grow, scale their business? Maybe they're struggling deal after deal. They're looking for some consistency. What would you tell that person?
I would say, don't be afraid to niche down and take inventory. Doing deals is one thing. Doing deals that get results are another. So take inventory. Is your niche working for you? Is the people you're working with good for you? Are you getting the results? Remember, we went into real estate not to do real estate, to buy back our time and enjoy it. Is that happening? And if not, don't be afraid to trade niches, or don't be afraid to niche down. Too many guys are going into 7 different directions. Get really good at one and stick with it.
Yeah, that's great advice. Last one. What does send more offers mean to you in your business?
For me, since I'm not really on that acquisition side anymore and we're providing properties, sending more offers for me personally is making sure I'm talking to more podcasters. I'm getting on more stages. I'm hosting more webinars. I'm building more relationships with potential sales partners. And for my property counselor team, I'm saying, are you, guiding your clients? Are you updating them on big news? So that's what it means for me is talking to more people.
Yeah, I love it. TTP. Good stuff. Well, look, Jim, this has been great. We learned a ton, exactly where you see things going. A lot of emphasis in the Southeast, Texas and Florida, how you were able to pivot in different economic times, even just explaining to us what the bulk foreclosure model looks like, and then why this build to rent model is so sexy. I love it. How can people continue to reach out to you or connect with you, follow you on social? Where can they learn more about your journey?
Yeah, if they want to go to southernimpressionhomes.com, you'll learn all about our journey. Also, if you go to jjplaybook.com, that's Jim and Jamie, my wife and I. This is kind of the story of us and our building partners' journey. This book just came out on Amazon. We'll make sure, too, Brandon, to get you some free digital copies if you want to give it out to some of your preferred listeners.
Awesome. Guys, as always, links will be in the show notes. And while you're at it, head over to sendmoreoffers.com. There's nothing for sale, but just a bunch of great information from some of the best guests and show notes. If you're in Atlanta and you can connect with me here at sendmoreoffers.com, that's the best way to get in contact. Jim, this has been great. I really appreciate you taking the time. I will continue to follow along in your journey. Super excited to see what you do next.
Me too. Thanks, Brandon. Good talking today.
Awesome. As always, guys, send more offers, do more deals. Till next time. Peace.
That's all for this episode of the Send More Offers Real Estate Show with Brandon Barnes. But we know you're craving more knowledge to get yourself ready for that next deal. To schedule a call with Brandon to learn more about how to do deals consistently without seller appointments in a repeatable way, be sure to visit us at sendmoreoffers.com. And be sure to tune in for the next episode of the Send More Offers Real Estate Show.